Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. Definitely had a great weekend here. Beautiful weather in Ohio, particularly for November. Peak foliage just passed. Still a lot of pretty leaves on the trees, and the Browns needed a big win, got a big win. So it was a victory all the way around. So with that, I'm going to jump in. I really appreciate everybody having all the great questions. Going to try to get through a number of them here in a succinct format as always. So first question is from Richard. What are the odds that innovation does outpace the inflation dynamics we are seeing, which does prove to be a temporary blip? So that's the Jeff Booth Price of Tomorrow scenario, which if you haven't bought Jeff's book, Price of Tomorrow, I would highly recommend buying it and reading it. It's excellent. So what are the odds that innovation does outpace the inflation dynamics we are seeing, which does prove to be a temporary blip? What are you watching on the innovation side, and what time frame would we be looking at for this to happen? In my opinion, the odds that innovation outpaces inflation dynamics that we're seeing, I think it's near 100% over time likely that innovation, the deflationary impacts of innovation will outpace inflation. The challenge within that is that global sovereign debt and really corporate debt, any corporate debt that's being used for financial engineering, right, or being financed with more debt rather than out of corporate cash flows, though all that debt requires inflation to basically not default over time. We'll take it to the extreme. So if you have innovation or technology-driven deflation in the presence of these massive quantities of debt, it's going to require central banks to either stand aside and let the system collapse, let governments default, let corporates default, and let the chips fall where they may, or continue to create base money at ever faster rates, can continue to QE, grow their balance sheets at ever faster rates, in an attempt to, which ultimately likely in vain, a vain attempt to offset the deflationary impacts of technology. Given that a lot of technology has followed Moore's law, or it's doubling every 18 months in terms of computing power, for example, they can't create base money that fast without creating problems for the currency. So basically what this dynamic refers to is either the deflationary impacts of technology, which I think will outgrow inflation over time, paradoxically require central banks to either stand aside and let the system collapse or fully reserve debt outstanding. In other words, basically put the entire or the most of or the entire debt market on central bank balance sheets. Print money, buy back debt. You're basically exchanging cash for debt. You're monetizing the whole debt market is what these deflationary forces will, in my view, force the central banks to do. It's what I think they are in effect doing. What does this mean for investments? In this scenario, you want to own base money-like neutral reserve assets, Bitcoin, gold, commodities, particularly those commodities where the supply-demand dynamics and the secular trends are very much in their favor. Energy, peak cheap oil, electric vehicles, uranium, things like that. So those are what I'm watching for. The one thing I would say that could void all of this kind of thing is some huge productivity increase. So nuclear fusion discovered, rolled out on a commercial basis to households around the country over the next 2 years, 5 years, something like that. It's a Hail Mary at this point, but that's something I'd be watching for. Okay, next question from Larry Chiang. Can you expand on the metaphor of the Fed trying to ride two horses with one ass? What are the two? Sure. So the Fed needs to let inflation run hot to inflate U.S. federal debt away down to sustainable debt to GDP levels that we estimate are around 70 to 80% of GDP versus 125% of GDP now, so that the Fed can then normalize policy without blowing up the system. However, so that's horse number one, is the Fed needs to inflate. Horse number two is the Fed also needs to convince the bond market that it will not inflate the debt away. Because if the bond market gets spooked that the Fed's going to inflate the debt away, it's going to bolt, and the Fed will have to be will either, again, have to let the system collapse because nobody from sovereigns on down can really afford much higher interest rates, or the Fed will have to explicitly cap the yield curve. In other words, they will have to buy all bonds at a certain price. The bond market will effectively put itself to the Fed. And once that happens, here again, we have the situation where if the Fed's effectively the only buyer, and certainly the biggest marginal buyer of the bond market, then the Fed's not going to be able to turn seller until debt to GDP has been reduced by inflation to levels where the Fed can begin selling without blowing things up. So you would likely see a very brief period, 6 months, 12 months, of extremely high rates of inflation if the Fed was forced into yield curve control in that manner. So those are the two horses. Fed needs inflation. Fed needs to convince the bond market that it's not going to inflate things away. From DC, what's the best counter argument to the inflation narrative that you can come up with? To me, it's a great question. The best argument against it is more political. And by that I mean, if the U.S. government and Fed decided to weaponize the dollar and the system against the world, and in particular China, we called it bombing inside the wire when we wrote about this in May of 2018, equating it to the movie Platoon, right? Where when they were overrun, when the U.S. forces at the end of the movie in Platoon were overrun, they called in airstrikes inside the wire, knowing they would probably kill a lot of their own men, but basically they needed help in the battle, and the killing their own men was acceptable collateral damage to killing the enemy that was overrunning them at the same time. So if the U.S. government and Fed decided to bomb inside the U.S.'s own wire, to basically stand aside, raise rates, let the dollar run away, and stand aside as the global economy collapses. I mean, imagine March 2020, except the Fed never comes. That would be, I think, the best counter narrative. And again, doing that for political reasons. Doing that if there is a sort of a financial World War III going on, and we really want to weaponize the dollar. Again, the collateral damage here would be extraordinary. I'm not sure it would even work, given that nobody has more sensitivity to rising rates and a rising dollar than the U.S. government itself, given its obligations. But that to me, I think, is the best counter argument to the inflation narrative. From Jordan Baker, how would you comment on Dr. Lacey Hunt's thesis that you can only create temporary inflation based on debt-based money printing, and then the last 100 to 200 years, all 24 advanced economies had to go through austerity periods? Let me preface this by saying I think Dr. Hunt is brilliant, and I think he's been dead right. Empirically, he's been dead right. With that said, I think also empirically, if you look at history, the rules begin to change once debt to GDP goes beyond a certain high level. Hirschman Capital estimates that number at about 130% debt to GDP. It also depends greatly on your current account position and your levels of deindustrialization. So once sovereign debt gets too high, sovereigns can and usually do print when that's what's needed to maintain nominal solvency of the sovereign debt. If that nation also has been deindustrialized by war, as was the case after World War I, or by trade policy, as was the case in emerging markets in the 80s and even in some of the 90s, and in the U.S. now, if you print money to keep sovereign debt nominally solvent while you are running big current account deficits and while you have been deindustrialized, you can also get extremely high inflation for sustained periods of time. As I said, highly indebted emerging markets have had no problems generating inflation since the 80s, regardless of economic activity, regardless of industrial production levels, regardless of employment levels, as the currency weakness induced to maintain nominal solvency of the sovereign debt while they were importing a lot of goods and while they had been deindustrialized can create a whole lot of inflation. Similarly, you had a similar dynamic after World War I. Dr. Hunt says, okay, he's saying emerging markets are not industrial advanced economies. Fair enough. After World War I, there were 6 industrial economies that were the 6 biggest economies in the world: the United States, the UK, France, Germany, Russia, Japan. They were representative of some of the biggest empires in the world and in history. Of those 6 industrial powers in the aftermath of World War I, 2 of those 6 hyperinflated, 4 of those 6 the other 4 significantly devalued their currencies repeatedly in some cases, generating sustained high rates of inflation. So that is, I think, where Dr. Hunt, I think he's not factoring in where we are in aggregate debt levels relative to trade flows and political and geopolitical and realpolitik realities. Okay, next question from BB. Also, over the last decade, gold has stagnated and silver has fallen, while Bitcoin has gone from basically nothing to over $65,000. If precious metals are a safe haven, wouldn't money be flowing into them by now? Could things be different this time? Things could always be different this time. I don't think they are. I think what we are watching is, look, central banks and the world's biggest energy exporter, Russia, have been flowing massive quantities of money into gold. You can see that in the flows. However, gold is a political metal. It is a managed market, and gold has done nothing as a result of that. We can talk about why that may be. There are a number of different potential reasons why that may, but price is the ultimate governor, and we can see it hasn't done much. Gold has not done much. Maybe gold continues to do nothing. If gold continues to do nothing, then either we have to have a draconian crackdown on Bitcoin from the authorities, draconian, or Bitcoin is going to disintermediate the global central banking system. And my view is that gold will ultimately continue to do very little until it does a whole lot in a very compressed period of time, for any number of reasons, up to and including the possibility that if central banks want to either recollateralize their balance sheet, recollateralize and stimulate their governments without growing the debt pile, they have to revalue gold way higher. Also, if central banks want to defend their franchise and not be disintermediated by Bitcoin without having the governments get very, very draconian on things like the internet, then again, they're going to have to use gold to defend their franchise. And when I say use gold, I mean like increase its price very significantly. And then the final question from AK. Interesting things from this week in no particular order. Huge U.S. trade deficit. Number 2, Gensler video on Ethereum. 3, infrastructure bill. 4, climate change conference numbers at $150 trillion from both Yellen and Mark Carney. And number 5, Yara and CF CEOs both warning about food shortages. The U.S. trade deficit, no shortage of dollars for China, right? And a very strong U.S. economy, apparently in the near term in terms of the trade balance. Gensler's video on Ethereum, I did not see. I need to watch it. On the infrastructure bill, I need to look more into that as well. The crypto provisions from Brian Armstrong at Coinbase tweeted about, I think is very much worth watching. There'll be some more reporting on that, I suspect. So I'm looking into that. It looks like they are looking to have more reporting requirements as it relates to crypto. So I don't think that that's a bad thing. The climate change narrative in terms of the $150 trillion, it seems like they are setting up a new neutral reserve asset, if you will. A new metric to inflate around. If we have to spend $150 trillion over the next 10 or 15 years, that is a significant amount of inflation. That's a significant amount of bonds that central banks can monetize under their mandate, as we've started to hear the Fed and I think the ECB as well talking about green being part of their mandate. And then finally, regarding the CEOs of the fertilizers, yeah, I think it's very important. I think you're seeing why energy is the master resource. Natural gas goes up, nitrogen prices go up. Yields, they're talking about not fertilizer shortages, nitrogen shortages as a result of natural gas prices rising. Nitrogen shortages, yields down next year equals crop prices up. And crop prices up, food prices up, more pressure on geopolitics, more pressure on but also more pressure on this whole narrative that this is transitory inflation. The transitory crew continues to ignore some of the limits to growth type data we are seeing in a lot of very important commodity markets. So we'll see. The Fed can't print oil. They can't print gas. They can't print corn. Copper ores are getting narrower and narrower in terms of. So there's a lot going on in terms of transitory, non-transitory. That discussion is being held almost exclusively on a monetary side of things. Very few people are looking at it on the geological and on the logistics side of it. But I think there'll be more and more people that are currently focused strictly on the monetary side, looking at the logistics and the geological side of transitory or non-transitory in coming quarters. So with that, I am going to finish up for today. I appreciate everybody joining me and for the questions, and hope everybody has a great weekend. As always, if you like these updates, check us out at fftt-llc.com for more information about what we're up to, more information about our tree rings product, 10 most interesting things with different excerpts about how they relate to themes either supporting of or non sequiturs to things we are and have been talking about. Getting a lot of great feedback on it. So thank you, everybody, and we will talk with you soon. Take care, everyone.